Hi everyone, it's me Navya and thanks for clicking this video and welcome back to the self-learning corner. And if you people are new or here, then welcome to my YouTube channel. In this video, we are going to talk about the MCQs related to Lecturer in Commerce KPSC exam. And in this session, I have taken the financial management MCQs. So let's begin this session. First question, which of the following is not included in the assumptions on which the Gordon proposed a model on stock valuation? And here the given options are retained earnings, the only source of financing, the finite life of the firm, taxes do not exist, and constant rate of return on firm's investment. Actually, in this question, they have asked about which are not the assumptions of this Gordon's model. So we need to focus the fact that we need to learn the assumptions of this Gordon model. Not only this Gordon model, all of this model and Walter model and Gordon model. All these are the dividend theories related to dividend theory. So we need to learn all of these approaches and we need to learn all of the basic assumptions related to all of these theories. So in this question they have asked about not the assumptions. So first options is what retained earnings is the only source of financing. Actually it is one of the assumptions included in this Gordon model and also in Walter's model too. And so it is not the answer. And next are the options is finite life of the firm, right? Actually the Gordon model says that the firm has a long-term life or very long life. And so here this option is not right. So it is the right option in this question because they have asked about which are not included in the assumption. So finite life of the firm is not included in Gordon's model because Gordon says that the firm has a long-term life, very long life. So and also Walter's model also says that firm has very long life of firm. And the next thing, taxes do not exist and Gordon's model include this assumption, the corporate tax do not exist and there is constant rate of return on firm's investment also. In Walter's model also we can say that IRR, that means rate of return on firm is constant and cost of capital is also constant. And in Gordon's model also we can say that the cost of capital is constant, rate of return is constant and growth rate of firm. Yes, this Gordon's model have another growth rate thing. Growth rate, the formula for growth rate is G is equal to BR, B into R. B means retention ratio and R means rate of return on the firm. And the firm has very long term life. The firm is an all equity firm. And all of these are the assumptions of Gordon model and Walter's model also have these assumptions, right? First thing, Walter's model includes the firm does not use external source of funds. That means only retained earnings will use, and also the firm has very long life. Also the IRR, that means the firm's rate of return, cost of capital are constant there, and also earnings and dividends remain constant there. And all earnings are either distributed as dividends or invested internally immediately. And we need to learn the theories, models, assumptions too. So we need to learn all of these basic assumptions related to dividend decisions, to theories of dividend. And next question, the overall capitalization rate and the cost of debt remain constant for all degrees of financial leverage is advocated by. And the given options are traditional approach, net income approach, net operating income approach and approach. In this question, the correct answer is net operating income approach. The overall capitalization rate, that is KO, and the cost of debt, that is KD, remain constant for all degrees of financial leverage is advocated by NOI approach. According to the NOI approach, actually this approach was propounded by David Durant. And it is a irrelevance concept because in this approach he says that the capital structure decisions are not relevant or irrelevant while determining the value of the firm because the increase in the use of debt would lead to increase the financial risk of the shareholders, and at the same time all of them are expecting a higher return for their shares. And because of this there would be increase in the cost of equity. So the benefit of use of debt, which is exactly offset by the increase in the cost of equity or capitalization rate of equity. and there is no one optimal capital structure. And in this theory says that the value of the firm is not affected by the change in capital structure, or capital structure is irrelevant. And because of that, we know that by using the debts, the KD and KO remains constant, and the KE, that is cost of equity, will rise. So in this question they have asked about the capitalization rate. That means KO and KD remains constant and KE will rise, and it is an irrelevance concept. And in net income approach, this theory was also propounded by David Durant. And in this theory they say that a company can increase the value of the firm and reduce the overall cost of capital, that is KO, by increasing the proportion of debt in this capital structure. Debt is generally cheaper, and because of mainly two reasons. The first reason is the interest rate is lower than the dividend rate, and the second reason is it is tax deductible expense for income tax purpose. And because of that, and you know what, the optimum capital structure of such firm is a point at which the overall cost of capital, that means KO, is minimum and the value of firm is maximum. In this theory says that if we use an increase in debt, the KD remains constant and KE remains constant, and KO means overall cost of capital will reduce. If the overall cost of capital will reduce, then you know what, the value of firm will rise. And this theory is relevant. This theory says that the capital structure decisions are relevant while determining the value of firm. So we need to learn all of these capital structure theories while learning this financial management thing. And the next thing, the degree of financial leverage reflects the responsiveness of, and the given options are operating income to changes in total revenue, EPS to changes in EBIT, EPS to changes in total revenue, and none of the above. And here the answer is EPS to changes in EBIT. That means the degree of formula for degree of financial leverage is equal to percentage change in EPS divided by percentage change in EBIT, which means that this degree of financial leverage measures the impact of change in EBIT on change in EPS. And also the percentage change in EPS is higher than the percentage change in EBIT. For example, we can say the degree of financial leverage is equal to 1.25. Then which means that if there is 1% change in EBIT, which leads to 1.25% change in EPS. So here the degree of financial leverage reflects the responsiveness of EPS to changes in EBIT. We need to learn the degree of financial leverage. And financial leverage, formula for financial leverage is equal to EBIT by EBT, and the degree of financial leverage formula is equal to percentage change in EPS by percentage change in EBIT. EBIT means earnings before interest and tax, or we can call it as operating profit. So the next question, match the following. And list 1 includes factoring services, economic order quantity, and commercial paper. And list 2 includes cash management, receivables management, inventory management, and working capital financing. And here the answer is option number C. What do you mean by factoring services? Factoring services is included in the working capital financing thing, or it is a part of receivables management. Actually, you know what, as a firm we will done credit sales. So there is usually a gap between the receiving that particular amount. So if a firm needs this amount immediately, then they will go for this kind of factoring services. That means the firm sells its receivables to a financial organization. That means we can call it as a factor, and we will sell this receivables at a discount, and they will give the money cash and we can use it for our business purpose. And at the same time, there is a difference between the face value of these receivables and the money which the factor gave us, and this difference will be used by the factor to meet the expenses related to the collection of debt or risk related to bad debts and sales, accounting, etc. And if there is a balance after doing this, then that will be the profit for the factor, and sometimes they will get commission instead of discount. And this kind of factoring services is a part of receivables management, is a part of working capital financing policy. And next thing is economic order quantity. Actually, economic order quantity is related to inventory management. inventory management, right? What do you mean by economic order quantity? It is the ordering quantity and which is most economical to order at a time, or it is the quantity that minimizes the total cost of inventory. And the total cost of inventory includes the ordering cost and carrying cost. Ordering cost means the cost of placing an order or acquisition of materials like transportation costs, salaries of staff engaged in receiving, inspection, placing an order, like that thing. And carrying cost includes the cost of carrying and materials, cost of holding materials, like that way. And the carrying cost plus ordering cost is equal to total inventory cost, and it is the ordering quantity that minimizes this total inventory cost is the economic order quantity. And we have some kind of formula. And EOQ is equal to root 2 AO by C. A means annual usage of material, and O means ordering cost of placing an order, and C means carrying costs. And we need to learn that formula, and a lot of questions are asked from this topic repeatedly. And so this economic order quantity is related to inventory management, right? The next thing is commercial paper. Actually, commercial paper is part of, commercial paper means that it is a source of finance. It is a source of short-term finance actually. Actually, it is we can say that it is a financial paper, and like treasury bill, or we can say it is an unsecured promissory note mainly to raise short-term funds. And it has a fixed maturity period ranging from 3 to 6 months, and also it is mainly issued by reputed organization, or we can say highly reputed organizations are providing these type of commercial papers, and like that way. And it's a part of working capital financing. So we can match this like factoring services is a part of receivables management of receivables. Economic ordering quantity is a part of it's inventory management, and commercial paper is a part of working capital financing. And so here the answer is option number C, B, C, D. And the fifth question, which one is not an important objective of financial management? The objective of financial management includes profit maximization, wealth maximization, and value maximization. So here the answer is maximization of social benefit. That means option D. All others are the objective of financial management. And the next thing is the concept of present value is based on the principle of discounting is the correct answer. Options are includes principle of compounding and principle of discounting, none of the above. And here the concept of present value is based on the principle of discounting technique. And the next question, match the following: Modi-Gilani-Miller approach, net operating income approach, short-term money market instrument, factoring. List 2 includes commercial paper, working capital management, capital structure, and arbitrage, right? So approach, Modi-Gilani-Miller approach is a part of capital structure, and also it includes the arbitrage thing. Arbitrage process means that, for example, we can say there are two firms, and firm has overvalued and a firm has undervalued. So we know that the investors of overvalued firm will sell their shares and they try to buy the undervalued shares of another firm. So in that cases, the overvalued shares of firm, the face value of their shares will reduces because and also the undervalued shares of firm, its face value will rises because, and the reason is that the supply of overvalued shares will increases, and which leads to reduce their prices, and the demand for undervalued shares will increases, and this leads to increase their prices. So, and this process will continue until the market value of both shares or both company will be same, and this is like an arbitrage process. So approach includes this process. And net operating income approach, as we said earlier, it is an important approach because a lot of questions are asked from this type of capital structure theories. And so net operating approach, income approach is related to capital structure, and it is an irrelevance concept theory. That means capital structure decisions are irrelevant while determining the value of firm. Then next thing, short-term money market instrument, which is related to commercial paper actually, because commercial papers are unsecured promissory note to raise short-term funds for that. Because of that, and factoring, as we said earlier, factoring is related to receivables management, and which is also related to working capital management. So here the answer is option number A, that means 4312. That means Modi-Gilani Miller approach is related to arbitrage. Net operating income approach is related to capital structure. Short-term money market instrument is related to commercial paper, and factoring is related to working capital management. And if you have enjoyed this video, and if you need more videos like this, then click on the like and subscribe button. And thank you for watching this video.